Hello everyone, and welcome to Chapter 23, Other Measurement and Disclosure Issues. This chapter goes through a bunch of different mini topics or issues, and what we're going to go focus on for this chapter, we're going to go through disclosures, segmented reporting, interim reporting, related party transactions, subsequent events, and financial analysis. Okay, so to get started, let's go into disclosures. So the full disclosure principle states that information relevant to decision making should be included in the financial statements. So whenever you complete the financial statements, you also have to complete the notes to the financial statements, and you need to put anything that is relevant for the users to make their decisions. Any facts that are significant enough to influence the judgment or influence the decision of the users should be included in a disclosure. Also, materiality applies to note disclosures. So if something is immaterial, it does not have to be included in the notes. So only material things that would influence the decision or judgment of a user should be included as a disclosure. All right, so now let's look at segmented reporting. So segmented reporting is reporting financial information based on different segments of the company. So for example, if you have, let's say like a phone company, so Rogers, for example, Rogers has business products and then they have consumer products. So they sell to businesses, they'll sell cell phones, internet to businesses, and they'll also sell it to consumers. So you and me will have a internet package or a cell phone package as well. So segmented reporting means reporting your company's financials in the different divisions that it has. So this could be based on the different types of products. It could be based, it can be based on the different regions. So you can have, Canada operations and American operations that can be based on that. Different like manufacturing division. So you can set it up in different areas. Okay, so what happens here is your sales amounts, variable expenses, contribution margin, they get split up between the divisions, and any traceable fixed costs, so any fixed costs that you can relate to the business product division or the consumer product division will be separated. But then there'll probably be some common fixed expenses that can't be allocated to each of the divisions, like maybe the head office or the CEO's salaries. So it's going to be hard to kind of split them up in the division. So those could be common fixed expenses. So this is what segmented reporting is. So reporting information based on the different types of segments your company has. The reason to get into segmented reporting is to better understand the enterprise's performance. It also helps on estimating future cash flows. If maybe you know where most of the cash is being used, and maybe you can do something about that. It makes more informed judgments about the enterprise as a whole if you're able to see the separate divisions. What makes up the total amounts. So in order for companies to have to report their segments separately, it needs to meet one of the three thresholds. Okay, so something is a reportable segment, which means that the information needs to be reported separately on the financial statements. If revenue of that segment is 10% or more of the combined revenue of all the segments. Okay, so you look at the total revenue of all the segments, and if segment A has revenue of at least 10% of the total revenue of the segments, then we would have to report that segment A separately. Okay, so it only needs to meet one of the three thresholds. So, or profit or loss of the segment is 10% or more of either the greater of the combined profits of all operating segments that do not incur loss, or the combined loss of all the operating segments that report a loss. So what you have to do is you have to add up all the profits of all the segments that have a profit, then add up all the losses of all the segments that have a loss, figure out which total is greater, and then use 10% of that total to see if it meets the threshold. And then number 3, assets of the segment are more than 10% of the combined assets of all segments. So this is similar to the revenue test. Okay, so there's 3 tests or 3 thresholds: the revenue test, the profit or loss test, and then the asset test. to determine if the segment that you have has to be reported separately. So let's try that. Okay, so it's pretty straightforward, but let's go and try that question. So go into your chapter 23 class exercises and go to question 1. So question 1 shows segmented information for 3 segments of the company. So segment 1, segment 2, segment 3, and then the total. So we have total revenue, we have the reported profit, and then we have the total assets of each of the segments. So let me just kind of show this separately so you can see that that's a total. So the questions are, which segments would be reportable segments based on the revenue test, the profit or loss test, and the asset test? Okay, so what I want you to do now is pause this video and attempt this question yourself. So do the 3 tests and see which segments would be reportable. And then you can unpause this video to look at the take up. All right, so let's take this up. So revenue test, very straightforward. You're going to take your total revenue of all segments and then multiply it by 10%. So 850,000 times 10%. So 85,000, that is your threshold. Okay, so that's the threshold. If any segments have revenue over 85,000, then they've met the threshold and have to be reportable segments. So then you can do a conclusion basically here and say, okay, so total revenue segment 1 is 100,000, so it is higher than 85. Segment 2 is 50,000, so it's lower than 85. Segment 3 is 700,000, so it is higher than 85. So segment 1 and segment 3 meet the threshold because they're over 85,000. So we know that segment 1 and 3 have to be reportable segments. But let's go to the operating profit test next. So we have a profit in each of these segments. So we just add up the total profit, 52,000, and then multiply it by the 10% threshold. So 52,000 times 10%. So our threshold is 5,200. Okay, so that's the threshold. So any segments that have profit of over 5,200 are reportable. So let's go back here. So 10,000 is higher than 5,200, 2,000 is not, 40,000 is. So again, segment 1 and 3 are reportable segments because they meet the threshold. Okay, let's do test number 3, see if segment 2 meets any of the thresholds. Okay, so asset test. We're looking at our total assets for all the segments, multiply that by 10% to find out the threshold. So 530,000 times 10%, which means our threshold is $53,000. So any segments that have assets of at least 53,000 are reportable segments. So 50,000 is not quite at 53. 30,000 isn't either, but 450,000 is higher than 53. So segment 3 meets the asset test. Okay, so segment 3. So if we look at all of these tests, segment 1 and segment 3 have met at least one test. So in conclusion, segment 1 and 3 are reportable. So that means that you have to present that information separately on the financial statements, but segment 2 did not meet any of these tests. So segment 2 does not need to be reported separately. So that would be reported with the common total expenses. All right, so I hope that made sense. If I change this up a little bit, so I had said the total, the greater of either the total profit or the total loss. So if, for example, this was segment 1 had a loss of 10,000, then to do the operating profit or loss test, we would add up the total loss. Okay. So I'm just showing you if there was a negative in there. So the total loss, there's only one, is 10,000. And then you would add up the total profit of all the segments. So only the segments that have a profit. Okay. So that's only the 40,000 plus the 2,000. Whatever is higher out of those two, so in this case, $42,000 is higher in this case, that's going to be the basis for your test. So you take 42,000 times 10%, and your threshold is 4,200. Okay, so is the greater of the total profit or the total loss. So you would compare the 4,200 to the reported profits here to find out which one would pass. So in this case, segment 3 would pass. All right, so let's go back into our PowerPoints and we'll go to the next topic. Like I said, there's a bunch of different topics, but they're very small. Each topic is pretty small. Okay, so that was segmented reporting, going through revenue test, profit test, and asset test. All right, next topic, interim reporting. Interim reporting means that you're reporting your financial statements over periods of less than 1 year. So it's very common for big companies to do this. So maybe they report their financial statements quarterly or semi-annually. Quarterly seems like the most common one. They could also do it monthly if they wanted to as well. The same accounting principles and methods that apply to annual reporting should apply to interim reporting. IFRS does not mandate interim reporting, so you don't have to do interim reporting. You would just have to create annual financial statements. There is no rule around creating quarterly or semi-annually or monthly reports. Companies do this to provide more information to their users. So IFRS doesn't say you have to do interim reporting, but it does provide guidance if an entity does want to provide it. And again, and also ASPE doesn't mandate interim reporting as either. All right, next topic, related party transactions. Okay, so a related party transaction arises when a business engages in transactions, so buying or selling something, so any type of transaction where one of the transacting parties has the ability to significantly influence the policies of the other or vice versa. So examples of this is companies under common control of a reporting enterprise. So if you have like a parent company and then 2 subsidiaries, the 2 subsidiaries would be related because they are in common control of the reporting or parent company. So the parent company, so all 3 of those companies actually would be related, right? Or investors where significant influence or joint control. So it's one investor. So for example, we can have like company A, company B, and then we have this investor. This investor owns, let's say, 55% of company A and 60% of company B. So this investor controls both company A and company B, so they can make decisions for both companies. So these 2 companies would be related. Another one is company management. So if there's, somebody like management that's part of company A is also the same managers as company B. Or another example is members of the immediate family. So maybe, a father owns company A and a daughter owns company B. Okay, so then these 2 companies would be related. Okay, so any family, company management, if there's the same type of people running company A and running company B, or the people running company A can significantly influence the decisions or policies of company B or vice versa. So that would be a related party transaction. So when recording related party transactions for both parties, IFRS says that we have to disclose the related party transaction, and related party transactions are recorded at the exchange amount. The exchange amount is basically the acceptable price between both parties. So what the both parties negotiated at would be the price. Under ASPE, we're either going to use the exchange amount or the carrying amount, depending on the decision tree that I'll show you in the next slide. So, for example, if company A sold, let's say they sold inventory, right? So they sold a product to company B, and they said, okay, we're going to sell it to you for $100. Okay, so company A sells inventory to company B, they're related for $100. Under IFRS, we will use the $100 as the amount to record. Under ASPE, it's going to depend. So it's either the exchange amount, or if the inventory was carried, the carried amount is $60, for example. That's how much it cost to make the inventory or to buy the inventory. And then under ASPE, it says we're either going to use the $60,000 or the $60 or the $100, and it depends on this decision tree that you have to go through. So let me show you the decision tree. So the first question you have to ask yourself in the decision tree is the transaction in the normal course of operations? So what this means is if they're selling that inventory to company B, so if A is selling the inventory to company B, is this something that's in the normal course of operations? Is this something that they're selling to everybody else? Like, is it just because it's the related party, or are they selling it to other people, other companies as well? Is it part of their operations? Is this what they do? So that's either going to answer yes or no, which will take you to another portion. So if we say no, if it's not in normal course of operations, if that's not what they do, then the next question you have to ask is there a change in ownership interest because of the item transferred? And is it substantive? So if company A is transferring a product to company B, does that change the ownership of how much company A owns company B, or company B owns company A? Okay, so that you would be answering yes or no. If you answer that no, if the ownership interests don't change, then we would measure at the carrying amount. Usually we would be saying no to this and measure at the carrying amount. If the answer is yes, then we have to find out if the exchange is supported by independent evidence. If no, measure at the carrying amount. If yes, then we kind of go through this part of the decision tree, which is the same as, is a transaction in the normal course of operations? If yes, then we'll go down to the next question. Is the transaction a non-monetary exchange or transfer of a non-monetary asset? So is there no cash involved? So maybe company A gave a product to company B in exchange for another product that company B gives to company A. So that would be a non-monetary transaction. Okay, so if the answer is no, this is not a non-monetary transaction, this was a cash transaction, then we would measure at the exchange amount. If it is a non-monetary transaction, then we have to ask, was the transfer for property that was held for sale? Okay, so was it held for sale in the normal course of operations? If yes, then we measure at the carrying amount. If no, then the next or the last question we have to ask is, does the transaction have commercial substance? If no, carrying amount. If yes, exchange amount. So when asking, does the transaction have commercial substance, you're asking, is there a significant change in cash flows from when company A sold to company B? Was there a change in cash flows? So if company A was exchanging like equipment to company B for an exchange of equipment, is that going to change the cash flows or at all? Okay, so either yes or no. So you'd go through this decision tree and then figure out, are we going to measure at carrying amount or are we going to measure at the exchange amount? Okay, so the carrying amount is whatever is on our books. The exchange amount is what both parties agreed upon. All right, so let's try a question about that. So if we go to question 2 on our Excel, so go into question 2. So we have 2 companies here. Verez Limited owns 90% of Consour Inc. During 2014, Verez acquired machinery from Consour in exchange for its own used machine. Okay, so they're basically exchanging machinery. Both companies are in the consulting business. Okay, so if the companies are in the consulting business, they're not in the business of selling machines, so it does not look like it's in the normal course of operations. The agreed exchange amount is $1,000. The transaction is non-monetary, and Consour carries its machine on its books at a carrying amount of $700, where Verez carries it at an amount of $900. Neither company has a balance in their contributed surplus related to the previous related party transactions. So that's important when we get to the journal entries, so I'll show you that. And both follow ASPE. Okay. So using the decision tree, determine how to account for the exchange under the following assumptions. So what I want you to do now is read all of these 5 assumptions and then find out whether it's on the carrying amount, if we're going to record this at the carrying amount or the exchange amount. So go through the decision tree, and then you can come back here for the take up. All right, so A, the transaction is not in normal course of operations, and the transaction has commercial substance. So let's go back to our decision tree. Okay. So if you go back to that, so it's not in the normal course of our operations. So the next question you have to ask is there a change of ownership interests? So if you look at, it says Perez owns 90% of Connoisseur. It doesn't say that after this transaction, now Perez owns 100% or 60%. So it doesn't look like there has been a change of ownership interests. Okay, so that would be no. So we would measure it at the at the carrying amount. Okay, so part A says measure at the carrying amount. Next one, the transaction is not in the normal course of operations and the transaction does not have commercial substance. And we know this commercial substance is not, if it's not in normal course of operations, then the next question we have to ask is there a change of ownership interests? No, there isn't, because they still own 90%. We don't have any information saying that they own a different percentage now because of this transaction. So again, we would go down that same line of, let me show you, no, not in normal course of operation. No, there is no change of ownership interest. So measuring at carrying amount. Part C says the transaction is in the normal course of operations. Okay, so assume that they do buy and sell machinery normally, and the transaction has commercial substance. So it is in the normal course of operations and has commercial substance. So is a transaction in the normal course of operations? Yes. Is a transaction non-monetary? Yes, it's an exchange of a machine to a machine. Is the transaction exchange in products or property held for sale in the normal course of operations? No, it wasn't held for sale. It doesn't provide us with information saying that. Does the transaction have commercial substance? This question C says yes. So we measure at the exchange amount. Okay, so it is in the normal course of operations and it does have commercial substance. So we would do the exchange amount. Part D, transaction is in the normal course of operations and the transaction does not have commercial substance. So one more time. So yes, normal course of operations. We already know that yes, it's non-monetary. No, it wasn't held for sale. No, it does not have commercial substance. That means we measure at the carrying amount. So A, B, and D, carrying amount, only C made it to the exchange amount. Part E says, briefly explain how your answers in part A through D would change if both companies were following IFRS. If you remember from the slides, for IFRS, we use the exchange amount. So basically from A to D, there would be, we would record at the exchange amount, and then we would also need to disclose the related party. It's not in this question, but I also want to show you how the journal entries work, because you're going to have that on your assignment question. So I do want to explain that. Okay, so if the Perez had to use the carrying amount, so either A, B, or D scenario. So if the carrying amount had to be used, let's look at what the journal entry would be for Perez. So they're going to get machinery with the carrying amount of 700. So we're going to record that as a debit to machinery. They're going to get rid of their machinery on their books, carrying amount of 900, so credit machinery. And then that $200 difference is going to go into a debit in retained earnings. Okay, so whenever you do a non-monetary transaction and there is a debit balance, the debit balance goes into retained earnings. If there's a credit balance, the credit balance goes into contributed surplus. So this is where this comes in. So neither company has a balance in contributed surplus. So if the company had some of a credit balance in contributed surplus, that credit balance could be zeroed out. So you could have debited the contributed surplus until that balance is zero, and then the rest would be debited or retained earnings. But so that contributed surplus cannot be a debit balance. Okay, so if you remember that, that means when you're debiting, and when you have to debit the difference has to go into retained earnings unless there is a balance in contributed surplus that you can zero out. Okay, in this example, there isn't. Neither company has the balance in contributed surplus. So we're going to use the retained earnings. And the books for consoir if the carrying amount was used. So they're going to get machinery of 900. They're going to get rid of their machinery of 700, which means that they're going to have like a gain, but we would record that as contributed surplus. Okay, so they get new machinery of 900, they get rid of their old machinery of 700 carrying amount, and then they will credit contribute surplus. Okay, so if it's a credit balance, into contribute surplus. If it's a debit balance, into retained earning. And this is only if the carrying amount is used. If the exchange amount is used, so the exchange amount here, they agreed that the exchange amount was $1,000. So in this case, the way you record the journal entries is just like you would if this was like a typical sale, like just any other type of sale of a machinery. So you sold it for $1,000. So we're going to debit our new machinery for $1,000 because that's the exchange amount. We're going to get rid of our old machinery for Varese, which was carrying at 900. And then we can actually record a gain. So we can record a gain on sale of $100. Okay, so if the exchange amount is used, then we can record a gain or loss on the sale of machinery. And then the last one for consoir, the new machinery, because the exchange amount was $1,000. So new machinery is $1,000. Get rid of the old machinery of 700, and then there's a gain of 300. Okay, so it wasn't asked to do the journal entries, but I just wanted to show you this because you will be asked in an assignment question. All right, so let's go to the next topic now, subsequent events. So subsequent events are events that take place after year end, but before the financial statements are complete. So if you just do kind of a little timeline, if your year end, so let's say, so for year end is here, December 31st, oops, December 31st, 2020. And then the financial statements are finalized, so the FS are finalized or complete, let's say March 1st, 2021, because it takes some time to get them finalized, to do your closing entries, maybe you get an audit or review done. This time period between when the year end is and the financial statements finalized, this is your anything that happens in between that time is your subsequent event period, basically. Okay, so we need to figure out if anything happens between this time, do we have to change the financial statements? So year end was December 31st, but financial statements aren't finalized until 2 months later. So if anything happens between these two dates, what do we do with that? What do we do with those events? So the events are categorized in two different categories, I guess, two different types of events. So events that provide additional evidence about conditions that existed at year end, or about events that provide evidence about conditions that did not exist at year end. If there's events that provide additional evidence of something that had already existed at year end, we would need to make an adjustment to our 2020 financial statements. Okay, so then we would have to go back and adjust these financial statements. If there was an event that did not relate or did not exist at year end, then we would just need to do a disclosure in our 2020 financial statements. So a good example of having an adjustment required is, so let's say that at the end of the year, so December 31st, 2020, you have an AR balance for one of your customers of, let's say, $100,000. Okay, so one of your customers has an AR of $100,000. After December 31st, so maybe a few weeks after, so sometime in January, you find out that this customer has gone bankrupt. And you're never going to get this $100,000. So this provides additional evidence about a condition that existed at year end. So at year end, we had a condition that existed. That customer owed us $100,000. We recorded it as an AR. We didn't do like a bad debt on it because we thought we were going to get that money. But then we find out a few weeks later that we're never going to get that money because the customer went bankrupt. So we're actually not going to get this $100,000. We're going to get zero. So you actually do have to make an adjustment, get rid of your AR, and record a bad debt expense for this, because you found out something. So like you made an estimate that you were going to get this money, you didn't put it in an allowance or write it off because you thought you were going to get it, but then you find out a few weeks later that you're actually not going to get it. So you have to go back and change this 100,000 to zero on your 2020 financial statements. The second example, so let's say that we have inventory, we counted our inventory, we have inventory of, let's say, $2.5 million at the end of December, okay? So December 31st, 2020. And then let's say in early February 2021, there was a fire and it ruined, let's say, it ruined $500,000 of the inventory. So $500,000, and let's pretend that this is a material amount. $500,000 of inventory was ruined in the fire. Would we need to adjust this 2.5 million to 2 million because 500,000 was damaged in the fire or lost in the fire? The answer is no, because December 31st, 2020, you did have $2.5 million worth of inventory. So that was correct. This is not an estimate. This was an actual thing that happened based on your inventory count. The fire happened afterwards. So what we would do here is just do a disclosure. Okay, so mostly, like if it affects estimates, then we would probably have to adjust. If not, if like this was the true case, we did have $2.5 million of inventory, but a few weeks later we didn't anymore, then we would just do a disclosure saying that there was a fire and that ruined $500,000 of inventory. Right? You know, we lost $500,000 of inventory. So some more examples that provide of event number 2, so conditions that did not exist at year end that need to be disclosed. So fire or flood resulting in a loss, a decline of market value of investments, a purchase and sale of a business. So if you sell your business or purchase a business after year end, you do have to disclose that. If there was start of legal action that happened after the financial statement date, a change in foreign currency rates, issuance of shares or debt. So sometimes companies want to wait till after year end to issue debt, so they don't show so much debt on their year end financial statements, but this does need to be disclosed. All right, so let's try going into question number 3 and looking at some. All right, so question number 3 shows the following subsequent events. So there's 12 subsequent events here. It says for each of the above events, indicate whether the company should either A, adjust the financial statements, B, disclose the event in the notes to the financial statements, or C, neither adjust or disclosed. Okay, so what I want you to do now is pause this video, try this question yourself, either A, B, or C in each of these 12 scenarios, and then you can watch the take up. All right, so to take this up, first one, settlement of a federal tax case at a cost considerably higher than the amount expected at year end. Okay, so in this case, at year end, you probably would have set up a liability, right? So like a contingent liability, for example. So you would have set up a liability, let's say of 200,000. Let's say that this is material, but you find out a couple of weeks after year end that you had to actually pay, so it says considerably higher. So maybe you actually have to pay 700,000. So do we adjust this liability to 700,000? Do we disclose it, or do we do none of the above? Okay. So what we would have to do is, because it does affect an amount at year end, we would have to adjust for that. Okay. So we would have to A, do an adjustment. Introduction of a new product line. Okay, so soon after year end, there was an introduction of a product line. Do we have to adjust anything from the previous year? Do we have to disclose, or do we do neither? Just nothing, okay, to the previous year financial statements. We don't do anything. So new product line has nothing to do with year end. It's it has everything to do with the new year, so we wouldn't have to do that. Loss of an assembly plant due to fire. So we did talk about this already. You don't have to change the amounts, but you do have to disclose it. So B, sale of a significant portion of the company's assets. So right after year end, they sold a significant portion of the company's assets. You wouldn't have to do an adjustment because those assets were still owned by the company at year end, but you would have to disclose that. So B, disclose. Retirement of a company's president. So right after year end, the president has retired. Here you wouldn't have to do anything, but it might be nice to disclose it, but you wouldn't have to, so neither. Right? A prolonged employee strike. So soon after year end, employees went on strike. That doesn't have anything to do with the numbers at year end, so you wouldn't do anything. Loss of a significant customer. This again doesn't have anything to do with the year-end numbers. Like maybe this year your revenue is going to be lower, but it doesn't have anything to do with year-end numbers, so we don't do anything. We don't disclose or adjust. Issuance of a significant number of shares, common shares. So after year-end, you issued a significant number of common shares. That would need to be disclosed. So that does affect the common share amount a few days or a few weeks after year end. So we would disclose that. A bankruptcy, so if your company is going bankrupt soon after year end, you would definitely have to do some adjustments there. Okay, so then you would have to adjust your amounts. Hiring of a new president, so similar to retirement of the company's president, hiring a new president would also be C. You would do neither. You don't have to disclose or adjust anything. Settlement of a prior year's litigation against the company. If you've settled a litigation soon after year end, then whatever estimate you had made as a liability would have to be changed. So you would have to do an adjustment on the financial statements because now you have better clarity into how much would have to be paid. So because like when you're setting up a contingent liability for amount that you might have to pay in the future, that's an estimated amount. When you have clarity on how much the amount is actually going to be, you would adjust your liability to show that if it's material. Merger with another company of a similar size. So if right after year end, you're merging with a different company, that probably calls for a disclosure. You'd want to disclose that to your financial statement users. Okay, so pretty straightforward. Think about, does this event affect the numbers at year end? And then if yes, do we need an adjustment or just a disclosure? Okay. All right, so let's go to our last topic for chapter 23, which is financial statement analysis. So you've been doing this throughout your accounting courses. So ratio analysis, looking at the relationship between two numbers, you've been doing it in all your accounting courses. You always have some sort of ratios that you have to look at. Horizontal and vertical or common size analysis, you guys did that in intro accounting, where you looked at the proportionate change between years. So how much the numbers changed year over year for horizontal. For vertical or common size, basically you looked at how everything is related to sales, for example. So in your income statement, how all your amounts are a percentage of sales. So what percentage of administrative expense is it to sales? Or on the balance sheet, what percentage is everything to total assets? And then we have trend analysis, how financial position and performance is changing over time. So looking at year over year kind of changes in your performance. So you have looked at most of these ratios before. So looking at liquidity, current ratios, looking at receivable turnover, inventory turnover, profitability ratios, gross profit margin. So you're already well aware of all these ratios, coverage and solvency ratios. So companies use these to determine management's performance, what the financial strength is, can they satisfy financial requirements or not. Okay, so that is the end of chapter 23. Thank you for listening and take care.